Hey, it's Wayne Wagner from Visionary Wealth Management, and I thought we'd take a minute and talk about kind of what's going on in the markets and kind of a base case and worst case, what could happen. So, in the near term, what our economy is trying to do is to basically burn off the rocket fuel that the government injected into our economy during COVID in the form of about $17 trillion worth of capital. So, the engine of the economy was running just fine prior to COVID. COVID hit and it was like the engine was going to break down. The politicians were afraid, so they figured we can't fix the engine, so we'll just run rocket fuel through it to try and get it to maintain its same pace. Well, they did that, but now COVID's just about over. And yeah, we've got some little peaks and valleys in the caseload and all that kind of thing. But the bottom line is that COVID is moving into the history books at this stage. We still have $17 trillion worth of rocket fuel in the economy engine. So we've got to burn that off before we can get back to kind of a new normal. Now, here's the reality. There's a lot of emotion in this because just like if you're on the highway and you're doing 90, not that any of us would actually do that, but if you're on the highway doing 90 and you get to the off-ramp and you're doing 30, it feels like somebody put both feet on the brakes. It feels like you're almost at a dead stop, right? Same thing's happening. The economy's been going at 187 miles an hour, and now we need to get back down to regular speed limit. So we've got to burn off a lot of capital here. Now, how do we do that? And there's a lot of different levers that get pulled throughout the economy to help us do that. So increasing interest rates, which should then depress the acceleration rate in things like the housing market, the borrowing markets. That's what the Federal Reserve is doing. We get a little bit of downtick in the stock market. So S&P 500 is down about 15%. The NASDAQ's off in bear market territory, down a little over 20%. So we've got to pull back in stock prices. We also have increasing earnings rates from companies on the stock exchange. So that's very good. That's a good metric because we want those companies' earnings to continue going up. So there's a bunch of different things in the economy, and it would be really, really helpful if we could actually just set a couple $1 trillion on fire and smoke it. The fact of the matter is we need a couple $1 trillion to just go up and smoke. Well, the market is helping us there too. I mean, Bitcoin is down about $600 billion since over the course of the last month or so. And many of the large cap companies, the mega cap companies in the stock market have come down pretty significantly. The good news at this point, the silver lining here, is that some of the valuations we're seeing from these companies, so the valuation on a PE ratio basis for Amazon is actually right now about where it was in April of 2020. Now, I'm going to say that again. The valuation of Amazon right now is at the same valuation it was at the bottom of the market in 2020 on a PE ratio basis because their earnings have come up and the price has come down over 30% at this stage. That's a base case scenario that, hey, maybe we're going to find a smooth landing here. Maybe we're going to find a new base to start building off of. That's good. Here's the worst case scenario. The worst case scenario is kind of when we look back in history. We were down in 2000 and we were down in 2001. And then we got a crisis, 9/11, and all bets were off for a while. We were down in 2007 and 2008. Stock market peaked in October 2007. By July 2008, the stock market was down 25%. Everybody said, "Hey, we got a nice little bear market going. Maybe it's time to start buying stocks and get more aggressive." And then we got a crisis. And so, for anybody who's saying we're absolutely at the bottom, it's not going to get any worse than this, the fact of the matter is we were 20 years into a downslide in 2000, 2001 before the crisis came. We were 9 months into a downslide in 2007, 2008 before the crisis came. Now, there's a chance we avoid a crisis, and we don't know what the crisis would be. I had somebody this past week tell me, well, Wayne, there can't be a crisis. They outlawed that after 2008. The fact of the matter is they outlawed the last crisis. They didn't outlaw the next crisis, right? So we want to be real careful about how we're approaching asset allocation. We're doing some rebalancing. We're doing a little bit of changing how we're approaching the bond market, the allocation that we have to fixed index annuities and things like that, especially for clients who are closer to or in retirement. We're being a little more protective of your money at this point in time because we don't know how long this kind of long, slow burn off process can go. And we want to be cautious about not getting a crisis. Now, I mean, if you go on the internet, you can find all manner of things that, there's a crisis around every corner. And there are some of those that are pretty legitimate. So with the war in Russia and Ukraine, the fact that so much of the world's grain is grown in those two countries and the fertilizer comes out of Russia, that gives us some pause and some concern about what may be coming with the harvest this year and what that might do to grain prices and things like that. Is that a crisis or is it just another speed bump? We don't know. A nuclear bomb would be a crisis, and we don't know what Mr. Putin over in Russia is planning at this point. So we have some concerns. We're being a little cautious. We're not cutting and running, but we are being a little cautious in how we approach things. As always, please feel free to call us anytime with your concerns, thoughts, or critiques. We're always here with perspective for the decisions ahead. Thank you so much for spending a few minutes with me here today.